Hello and welcome to this video tutorial on market cycles. I'm Adam Khoo once again, and in this video you're going to learn about the different phases the market goes through. And it's important to understand that different strategies tend to perform well under different market conditions. And basically there are four cycles the market goes through, the four cycles, right? The first cycle would be the uptrend cycle. This is when demand exceeds supply and more retailers are piling in, pushing the share price up. The market is bullish, it's optimistic, and you find that price tends to make higher highs and higher lows. And for most of the people, you'll find that it's the easiest time to make money because almost every stock you buy will tend to go up. Now, uptrends don't last forever. Eventually, uptrends would start to top, and it will then go into a consolidation distribution phase. Okay, where the market moves sideways, directionless, and we call it a distribution phase because that's when big institutions start to sell shares of stock, but they don't do it fast enough that they cause a panic. They do it slowly, right? And they're selling more than they buy. And who's buying at this phase? Unfortunately, the retail investors, the late laggers to the market start to buy at this phase. And once most of the shares have been distributed, okay, and the retail investors realize that no one else is buying, they start to panic, start to sell, and that's when the market goes into a downtrend phase. When the market is pessimistic, it is bearish, and prices make lower highs and lower lows. Now, eventually, the downtrend will bottom, and it normally bottoms once the last retailer sells in panic, okay? And after the downtrend ends, you have got another consolidation phase where the market moves sideways, except it's a accumulation consolidation phase. And the difference is, at this point of time, big institutions are beginning to accumulate shares slowly. They don't accumulate fast enough that they drive the price up, but they accumulate slowly so that the retail investors can't see. And once they've bought enough, they start to buy more aggressively to push the share price up. And eventually the market will break up into a new uptrend. And slowly as the uptrend begins to unfold and goes higher and higher, more retail investors start to pile in. And again, the uptrend will then form into another consolidation distribution and a downtrend. And the cycle continues. Now, most of the time, the cycles go in this sequence: uptrend, consolidation distribution, downtrend, and consolidation accumulation. But not always the case. It's not a perfect science. Sometimes it can go from uptrend and reverse immediately into a downtrend. Or it could go onto an uptrend. It could go through a consolidation that looks like a distribution. And the next thing you know, it breaks up into a new uptrend. So everything is possible, but more or less, it follows this sequence. So let's take a look at the different phases closer, and what kind of strategies tend to flourish under each phase. So again, the first phase is the uptrend phase, or we call it the bull market. And this is very obvious because during this time, demand exceeds supply. And so the market is optimistic, the market is bullish. Whether it's good news or bad news, the market still goes up. And normally during the uptrend phase, you find that the moving averages tend to be sloping up in a particular sequence. Very often, the 50 moving average, imagine there's a 50 moving average, will be above the 150 moving average, and it'll be above the 200 moving average as well. That's a very clear uptrend. Okay, and an uptrend is defined specifically as price making higher highs, higher high points, and higher low points, as you can see. So once again, when the market's on an uptrend, you find that it's very easy to make profits. Any monkey can make money. You throw a dart, 7 out of 10 stocks will go up. So long trades and trend following trades tend to do really well in an uptrend market cycle. Now specifically, when's the best time to enter on an uptrend? Now, during an uptrend, you realize that prices don't go up in a straight line. They tend to go through certain patterns as they move higher. And the first pattern that it goes through, it's a very regular pattern, and it's what we call a wave pattern, something like that. It goes up and down and up and down in this sequence, okay? And during this time, it tends to bounce off one of the key moving averages, like bouncing off the 50 moving average, 100 or 200 moving average, or bouncing off a very clear trending support line. So whenever you see the price is bouncing off the moving average in a very predictable way, when do you enter? Simply, you buy over here. When the market bounces off the moving average, that's when you take a long position, a long trade, when it bounces off the moving average. Okay, somewhere around here and around here. Okay, so that's the first pattern that tends to come up during an uptrend. The second kind of pattern that comes up is when the price, as it goes on an uptrend, right, it goes up, and what it does is it starts to make lower highs. In this case, lower highs. You can see lower highs in a kind of short-term counter trend move. But the overall trend is still up because the price, as you can see, the 50 is above the 150 moving average, and the price above the 200 moving average. So the overall medium-term trend is up, as you can see on an uptrend, but at the short term, it's making a short-term counter trend move down, kind of like a spring. That the spring is coiling, and usually it breaks out of that pattern as it breaks out of that counter trend line. So when you see a pattern like this, then what you can do is to enter when the price breaks out of that counter trend line, which usually forms kind of like a wedge pattern. So you buy basically on this breakout. Okay, so that's another form of entry on an uptrend. During an uptrend, the price can also make very small sideways consolidation patterns. Now, this is not to be confused with the big consolidation distribution or consolidation accumulation. These are small consolidations along the uptrend. So what happens is the price goes up on the uptrend, okay, and then makes a small consolidation along the way, where it's defined as making same high, same high, same high, and same high. And it should be tested at least 3 times to be a confirmed resistance. So when you see this pattern, what you want to do is to buy only when it breaks out. When you see the candle breaking out of this resistance, that's when you can enter a long trade. So you buy on the breakout over there. Okay, here's another example where the price is on an uptrend, test 1, in fact that's test 1 here, test 2, test 3, breaks out, and you can buy over there. Okay, so you can buy on the breakout of the resistance, or you can buy the pullback to the resistance support line. So what happens is sometimes after the price breaks out, okay, this is called a breakout because it breaks out of this resistance level, as you can see. Okay, so you could buy on the breakout, or after it breaks out, you wait for it to pull back to test this support. Because after a breakout of resistance, the resistance becomes support. That's support resistance 101, right? Do review that video if you're not sure. And when it pulls back and is able to hold that support and bounces back up, then you could also enter over here. This is called buying on the pullback. So you can either buy on the breakout or buy on the pullback. Again, pullbacks don't always happen, so it's up to you which entry point you're looking for. Now, when does an uptrend end? Okay, an uptrend phase usually ends when the price makes a final parabolic surge. So what does parabolic mean? Parabolic means going up almost 90 degrees when the market is euphoric and they think that the price will go up forever, and that's when the late retailers come in and push it up to unrealistic and unsustainable highs. So usually on a healthy uptrend, you see the price going up like that at a 45-degree angle. And what happens is eventually near the end of the uptrend, you find the price will start to go up at a 90-degree angle when it's parabolic. Okay, so once you see the price starting to go at a 90-degree angle, you can be sure that the uptrend is coming to an end. Okay, when it's highly overbought, and usually at this point the price goes up so fast that it is very far from the moving averages, right? It in fact pulls away from the 20 moving average, and not to say the 50 moving average would be a lot further behind. So that's when you know it's gonna kind of like top up, all right? And once it makes that high over there, you find that subsequently it can't make higher highs. It makes a lower high over here. So once it can't make a higher high, it makes a lower high or makes the same high, you know that the market has topped and it's going to go into a consolidation distribution phase, or it's going to plunge immediately into a downtrend. So those of you who are more experienced traders, all right, especially going through Wealth Academy Professional and all those things, you know that when you see a parabolic move to the top and you get a very powerful reversal pattern through the candlestick patterns, you can begin to do a counter trend short sell trade to short the stock and make money as it collapses over here. Again, this should only be done if you're more experienced in trading and not if you're a beginner. Okay, so that's when we can do a parabolic short over here. So that ends the bull market, that ends the uptrend cycle. Now let's go into the next cycle. Okay, now we come to the second phase, the consolidation distribution phase. So this phase begins after the end of an uptrend. And like I mentioned earlier, this is when institutions are slowly reducing and distributing shares of stock. Okay, and again, they're not doing it in a fast way that the market can pick it up. And it creates that downward pressure where supply exceeds demand. So they're selling slowly, but they're getting rid of their shares. Okay, so during this period, it's quite obvious because the market doesn't make higher highs anymore. In fact, you can find, you see, this is a high over there. It makes a lower high, a higher high, higher high, and then lower high. And so more or less it's kind of like going sideways, right? And the moving averages tend to start flattening. From sloping up, they tend to flatten. And again, it's one big giant consolidation over here where you have a big resistance and a support over here. So you find that during this phase, trend following no longer becomes profitable. That's when you buy and you're hoping that as it goes up, you make money. You get very frustrated because once you buy, it doesn't go up very far, comes back down again, may hit your stop loss. You find that when the stocks break out of consolidation, you buy on a breakout and the breakout fails. So when you start to see a lot of these things happening, breakouts failing, trend following doesn't go very far and comes back down again, you can bet you're in this cycle. All right. So for trend followers, they may seem to get really frustrated during this cycle. They say it doesn't work anymore. The markets have changed. I've got news for you. Markets don't change. Human beings never change. It just goes through cycles. Okay. So you got to be able to go through these cycles and be there once the market starts trending again. But having said that, during this cycle where it's going sideways for a couple of months or even a year or so, you can make money on certain strategies. So for example, in this cycle, what is profitable would be trading the range strategy, where you pick stocks that are in a very clearly defined range and you buy when it's near support and you sell when it's near resistance. All right, that's called trading the range. What is also profitable would be mean reversion strategies, when it gets a bit too high and you short it, it gets too low and you go long, and you can tell when it's overbought, oversold using indicators like Bollinger Bands, stochastics, and things like that. You can also look at divergence reversal patterns, right? Bullish divergence. Price makes higher highs, maybe in this case, but MACD doesn't make higher highs. And you can do a short trend or short-term counter trend trade down, okay? Or you get a bullish divergence reversal pattern where price makes lower lows, MACD makes higher lows, and you can do a quick long counter trend up and get out. Okay, what is also profitable would be what we call non-directional strategies that are normally used by options traders, which is beyond the scope of this course. Things like, iron condors and covered calls and short straddles and short strangles and all these cute names. Okay, but no worries, if you're into trend following, it doesn't mean you have to change your strategy. Just keep doing what you're doing and understand that in these phases, you just have got to go through that frustration, and the market will start coming back into a trending phase again. So usually in this cycle, there are some repeatable patterns you see when market tops and it goes through this consolidation. And one of the common patterns you see would be a double top pattern. The price goes up, makes a high, comes down, makes another high, and normally it would be at the same level or slightly higher. Okay, slightly a higher high and comes all the way down. So that's called a double top pattern. So some traders, what they do is they see this first top, okay, and once they see this second top exceeding the high of this, and they wait for a bearish candlestick reversal pattern. For example, you may see a morning star pattern, or sorry, an evening star pattern, a bearish pin bar pattern, a one black crow pattern, and it could be confirmed by an overbought condition. Like stochastics are overbought, the price is above the Bollinger Bands, and you could do a short sell over here. You can do a short to catch the trade going down. Again, this is more for experienced swing traders. Another common pattern is the head and shoulders pattern, where price goes up, comes down, goes up to make a higher high, comes down, and makes a lower high again. So it's kind of like a head over here and two shoulders, okay? So normally what traders do is they draw a line, okay, somewhere here, and if it breaks this neckline, because this is called the neckline, they go short, anticipating the downtrend after this big consolidation pattern over there. So that ends this phase. Let's go on to the next phase. So usually after the consolidation and distribution, the market will then go into a downtrend. So a downtrend is also known as a bear market, and it can last for anywhere from 1 year to 2 to 3 years. So during this phase, supply of shares exceeds demand. Everybody wants to get out, they're panicking, they're selling, and no one is buying, all right, especially the institutional buyers. So usually on a downtrend, you find that the market or the price is making lower highs like that, and lower lows. So that's the definition of a downtrend. Okay, so obviously on a downtrend, investors will get crushed. Okay, those who are buying and holding would have to really suck it up and close their eyes and not kill themselves, right? Because that's when stocks can collapse 20, 30, 50, 60, 70% at times, all right? And 7 out of 10 times if you go long, you're going to lose money. But this is a time when the short sellers make a lot of money. That's when you short sell any stock, if you take any monkey and throw the dart at any stock, 7 out of 10 will go down. So you want to be short the market. That's when you make money on a downtrend. So on a downtrend, you find that the price is usually below the moving averages, below the 50, and the 50 is usually below the 150, and the 150 is usually below the 200 moving average. And the moving averages are all sloping down in sequence, okay? So again, this is a time when it's really easy to make money when you're taking short trades or you're doing trend following to the downside, Okay, and if you're going long, you're going to lose money easily, right? So when's the best time to short the stock or the market on a downtrend? Well, again, it depends on the pattern, and there are various patterns. And the first pattern you will see is when the price is bouncing off the moving averages. So when you see this pattern like that, price is bouncing in a very predictable manner, right? So you see it's lower highs and lower lows in this very nice wave pattern. And every time it rallies, it hits a moving average and bounces and comes all the way down. So when you see a pattern like that, it's very obvious that you definitely want to sell somewhere over there once it has bounced. Once it has bounced, you can short over there. Okay? Another pattern you see is that when it's coming, sometimes when it's coming down like that, it would tend to temporarily, in the short term, make higher lows. Okay? It makes higher lows. So again, the overall trend is down. The overall medium-term trend is down. The 50 is below the 150 moving average, below the 200 moving average, right? So it's overall downtrend, but in the short term, the price is making a counter uptrend like that, counter uptrend, making higher lows. So you can easily draw a counter trend line somewhere like that. So when you see this pattern, when you short it, obviously you do not want to short it when it's above this counter trend line. But once it breaks the counter trend line and it's going to continue down, you can short it over here, somewhere over here. Okay, so this is again a very common pattern. So you short it over there or short it at the breakdown over there. Okay. Now on a downtrend, again, the price can make mini consolidations where price goes down, hits a support, test 1, test 2, test 3. Again, it has to test at least 3 times to confirm it's a strong support, and it's in this small little consolidation on an overall downtrend. So when you see that pattern, when do you short? You short when the price breaks below this support level, right? And you can do a short sell over there, take it all the way down. Here's another one. Price going down, hit support, 1, 2, 3, 4. It has to test at least 3 times. It tested 4 times over there. And then it breaks. So once it breaks, you could short it here. Okay, so we short the breakout to the downside, or if after it breaks, you can wait for a pullback for it to test the resistance that has now become support. So once it tests it, it comes down, then you short it over there. So you could short it on the initial breakout or short it on the pullback and the test. Okay, so similar to the long, it's just opposite direction. So downtrends are fun. You can make money on downtrends. So how do you know when a downtrend is going to bottom? Okay, so again, a downtrend bottoms when the price makes a final parabolic plunge. Okay, so usually on a downtrend, again, the price moves 45 degrees. Okay, so it goes like that, right? Market gives people hope, kills them, gives them hope, kills them, teases them, kills them, teases them, kills them, right? So increasingly people get more and more frustrated because they think it's going to go up, they buy and they die, they buy and they die, right? But it comes to a point where people start panicking and they say, you know what, the market will never recover, I'm out, and that's when the price plunges 90 degrees and we've got panic selling. And that's what we call capitulation. Capitulation means to surrender. And I always like to say that the price can only bottom when there are no more sellers left. If there are no more sellers left, the price can't go lower. So there are no more sellers left when the last seller has sold. Okay? When the person who had all the faith all the way lost faith and says, you know what, I'm going to throw in the towel, it's over, I'm out. And that's when the market bottoms. Okay? And that's when you can use the capitulation strategy to buy when the last guy jumps off the building. Okay, that's when you can buy over here for a quick counter trend trade upwards using the capitulation strategy. Okay, so that's when the market bottoms. So after the market bottoms, two things can happen. We either rebound very strongly into a new uptrend, okay, or we go through a consolidation accumulation phase where the institutions slowly accumulate, and then push it into an uptrend again. So let's take a look at this last cycle. Okay, so now we come to the consolidation accumulation phase, and this begins after a downtrend. And during this phase, you find that institutions or the big boys are slowly amassing shares of stock. So this is when the institutions accumulate shares slowly, right? Not fast enough that people start to realize it, but slow enough that the price moves sideways. So we also call this the basing period because the market builds a base, a foundation, a base before eventually breaking out again, okay? And usually you find that in this phase, negative news no longer affects the stock price. In a downtrend, every time there's a bit of negative news, boom, the price goes low, boom, it goes low. And it comes to a point where, the market's so used to it, no matter what bad news comes up, the price, like, I don't care, I'm not going down anymore, right? And that's when you know that, hey, you're in this phase. So when is this stage complete? Well, this stage is complete usually when a key resistance level is broken. So during this accumulation phase, you find that the price can't seem to break a certain high. So these are the highs over there, as you can see. So it forms again a resistance, okay, and usually, of course, a certain support level, okay. So once this main resistance level is broken over here, okay, it breaks here, that's when it breaks out of this phase and starts a new uptrend. So you can enter the trade once it breaks out of this strong resistance level. And usually at this point, the price would also have just crossed the 50-day moving average most of the time, right? As you can see, the price in fact crossed the 50-day over here, but it would have been risky to take it because it's still below the resistance. So over here, when it broke the resistance, it's above the 50, and you could have taken the trade, start the new uptrend. Or you could have waited, in fact, for the 50 to cross the 150 to buy on the uptrend, okay? So usually by that time, it may have gone up by quite a bit. So if you want to take an earlier trade, you could enter based on breakout of the resistance and above the 50-day moving average. So before that happens, you find that again, during this phase, okay, trend following is again not really profitable because the market's going nowhere, it's going sideways. So whether you're going long or going short, it can be quite frustrating because it's not hitting your profit targets. But again, during this period, you can make some quick money through short-term swing trading, which is again trading the range, buying on the support, selling at resistance, and repeating the process, right? Buy here, sell there, You could also trade divergence reversal patterns, okay? Bullish divergence and bearish divergence. You could also enter based on capitulation and exiting once you get a 2R before it hits a resistance and comes back down again. And again, non-directional strategies. If you're into options, you can look at, again, your iron condors, shorting your iron condors, shorting your straddles and your strangles, okay? So again, during this consolidation, accumulation phase before the uptrend, there are some repeatable patterns that you may see. One would be the double bottom pattern, okay, where the price comes down, makes a low, and then comes down and makes a slightly lower low, okay? So it's a double bottom. So again, experienced swing traders, once they see that the price has made a lower low, taking out this previous one, they see a double bottom, and if they see a powerful reversal candlestick pattern that's bullish in nature. For example, they see a morning star over here, or they see a bullish pin bar, or they could see a capitulation with a one white soldier. You could take a buy order over there. Okay, so another one would be, you could have a triple bottom, goes down 1, 2 and 3, boom, right? It could also be a triple bottom sometimes. Okay, like so, right? 1, 2 and 3. Okay, could also be a triple bottom pattern. So to summarize, again, you find that the market goes through these 4 cycles, right? The uptrend, the consolidation distribution, the downtrend, and the consolidation accumulation phase. So why is this important to understand? Because whatever strategy you use will not perform all the time. It will perform under certain conditions and not so in other conditions. For example, again, if you're into trend following and you're the type of person who goes long on uptrends, you find that during this phase, you feel like a genius because anything you touch will make money very easily, and you have very high win rates, 80%, 90% win rates. You get 2R, you get 5R, you're a genius, right? And you're making a lot of money. Whoa, you're really happy, right? But guess what? After a while, when it goes through this phase, you find that your trend following doesn't make money anymore. You start to get frustrated. You break even, minus 1R, minus 1R, minus 1R. Okay, and what happens to some people is that once they start to lose some money here or not make money anymore, they start to think that the strategy doesn't work anymore. Okay, and there's this overwhelming temptation to change their strategy, and they say, okay, so this is not making money. What is making money, right? And they see someone who is doing a non-directional technique. For example, they're trading options, or they are using a counter trend trading technique, and say, hey, they're making all the money over here. All right, so I should be using their strategy, right? Because their strategy works in this phase. So what happens to this trader is they'll start to abandon their trend following strategy and use this new strategy, which is making money, right? But by the time they learn it, guess what? That's right, the market goes on a downtrend. And once the market goes on a downtrend, these mean reversion or option strategies start to lose a lot of money. And they say, damn, what's happening? By the time I learn it, I'm losing money again. And they didn't realize that if they stuck to their trend following style, but instead of going on uptrend and now go on downtrend, they'll be making money again. Okay? And then what happens when they start to see that, hey, now the trend following is making money, I want to go back to trend following. But the moment they go back to trend following, it goes sideways again, and again they're losing money. So they always lose money in every cycle because they keep switching strategies, all right? So the most important thing to succeed as a trader is to stick to 1 or 2 strategies and keep trading the same system and master the system. And understand that, right, it can't make money really well all the time. Okay, but if you keep using the same strategy, right, you'll make tremendous profits here. It may break even, lose a bit of money here, make tremendous profits here, and overall, you'll be profitable. And if there's anything that you learn from this video, please learn that. Stick to your strategy, okay, and master it. The market rewards specialists and not generalists that attempt to do everything. So with that, thank you for listening. This is Adam Khoo. And if you got any questions, send me an email. I'll be glad to help out. Take care.